So limited company financial statements. In fact, the other day we have started. Let's continue from this. IAS 1 talks about presentation of financial statements. There are 4 financial statements. Statement of financial position, or what we call it as balance sheet, statement of profit and loss and other comprehensive income. The third statement is statement of changes in equity. Fourth one is statement of cash flow. Apart from these 4 statements, any information that is not included in these financial statements would be presented in the notes to financial statement. That's additional information which the stakeholders would be interested to know. So for their benefit, this additional information will be included in notes to financial statement. So all these things are mandatory to be prepared and disclosed for the benefit of the stakeholders. Stakeholders are users of the financial statements. We also discussed about the balance sheet, statement of financial position on the asset side. Broadly categorized, the assets are categorized into current assets and non-current assets. Under non-current assets, the tangible assets, which are property, plant, equipment, and the intangible assets. Under the current assets, we have the cash balances. The one second. So under the current assets, we have cash balances, receivables, and inventories. On the liability side, liabilities are classified into 3 categories: the current liabilities, long-term liabilities, and equity. Equity section has share capital, share premium, revaluation, surplus, and all undistributed profits, retained earnings, reserve, surplus, whatever is that called as. Non-current liabilities, any kind of a liability raised which has to be paid in a period in more than 1 year. If the maturity period is more than 1 year, it is categorized as long-term liabilities. Then we have the current liabilities, where we have payables, tax, any kind of liability that has to be settled on account of taxation, dividend, outstanding expenses. All of them would be accounted here under current liability because they have to be met in the next 1 year. Then income statement, the regular activities would be part of the income statement, profit from operations, any interest cost, any finance costs that are paid. Below that, we would see that. So this is the first part of the statement of profit or loss and other comprehensive income. The regular business, the continuing operation, the ones which we do, that would come as part of continuing operations. The profit for the year is calculated. Below that, those irregular items which happen are accounted under the heading called as other comprehensive income. Together it is the entire income statement with the continuing operations and other comprehensive income together is called as comprehensive income statement. Sometimes certain items which happen from the activities that were discontinued earlier. Maybe one unit of the business was closed or one product was discontinued, some activity was discontinued. Out of that, if there is any transaction that happens in the current period, that also will be accounted, but separately it would be below this other comprehensive income. We would see that transaction recorded as income from discontinued operations. Okay, that also would be there. That is part of the income statement. The other day I did discuss about how the statement of changes in equity would be recorded. Simply we see that it would be the beginning balance, the opening balance. To the opening balance, any kind of changes that were made. The changes could be on account of additional capital brought in, any increase in capital, additional capital brought in or share capital that is issued. Then any additional profits that are earned, that is all types of increase in profits, P&L account, etc. Profit and loss could be added. The other things like a revaluation happening and the gain, because revaluation is on account of increase in the value of asset, that's the gain. So increase in revaluation. Okay. Would be increasing the opening balance. Apart from that, any kind of a payment that is made, that is dividend payment that is made, is deducted. And the resultant figure is the closing balance. This is basically what is the change that happens with respect to equity in the current period. So for each category, there is a separate column which is prepared. Generally, share capital once it is issued, it would be at the same value. So there's one column exclusively for share capital, share premium. Any revaluation that has happened, the gain on revaluation which is accounted, it's a separate column. Profits that are set aside for certain purposes, one column called as reserves. Then we have retained earnings. Retained earnings will account for all the profits that are earned in each year will be accumulated in retained earnings. Out of retained earnings, any payments for dividend payments would be met out of that. If dividends are distributed, they would be distributed out of retained earnings. So the adjustment will go against the retained earnings. So that would be accounted. So sometimes we also see that exclusively for this particular section, retained earnings, also there is a statement very specific, because the operating activities, non-operating activities, the profits that are realized, they are accounted here in retained earnings. So statement of changes in retained earnings also in certain cases is exclusively prepared. Okay. So the opening balance, anything transferred to the reserves, it will be taken from the retained earnings and transferred. The current year's total comprehensive income that is earned for the current year is added, it gets accumulated. Dividends that are paid are deducted from retained earnings, and thus the closing balance. So the sum total of all these transactions is the total equity which appears in the balance sheet. Next topic is IAS 10. How do we treat those events that happen after the reporting period? The financial statements, the accounting period ends on the last date of that 12 months period. See, for us in India, it ends on March 31st. So the financial statements are also supposed to be prepared as on that particular date. But technically speaking, precisely on that very specific date, the financial statements are prepared is not a possibility. Everything would be settled, closed, the financial statements are prepared. It would not happen. So usually it takes few days. Few days would take for them to finalize, prepare the financial statements of the business. So during that, the accounting procedure is the transactions are journalized, posted into ledger accounts, balances come to trial balance. Trial balance becomes the base for financial statements, preparation of financial statements. See, even after the trial balance is prepared, certain adjustments are realized. In the last classes, we did discuss about that. Those adjustments are directly posted into the financial statements. For example, closing inventory. So closing inventory, instead of passing a journal entry, ledger posting and all, so it would directly go into the financial statements. One effect is the credit side of the trading account. The second effect is it is shown as an asset on the asset side of the balance sheet. Depreciation to be deducted. So the asset value is reduced by the amount of depreciation and it is shown as an expense of the P&L account. Two effects. So certain transactions take place after the trial balance is prepared. So now, before the financial statements or the final accounts are prepared and the closing date, between the closing date and the date when the financial statements are prepared, we see that there are certain adjustments which appear. They relate to the current period, but they were not realized immediately that journal entry, journalizing, posting into ledger account and the rest of it to take place. That would have that was not possible, that was not done. So when these kind of events happen, events after the reporting period are those events that are favorable or unfavorable that occur between the end of the reporting period and the date when the financial statements are authorized for issue. During that period, in between these two dates or between this period, so we see that there are certain events that happen. They are categorized as, some of them are adjusting events and non-adjusting events. So what's the treatment with adjusting events and non-adjusting events? First, adjusting events are those that provide evidence of conditions that existed at the end of the reporting period. What do we do if there is an evidence that these transactions took place or the evidence existed for that? The financial statements must be adjusted. So even if they are realized after the closing date, see, let's say if it is March 31st, see the transaction, the event appeared, maybe let's say April 2nd, April 3rd, sometimes. By then the financial statements are not finalized, they are not prepared. They didn't appear before March 31st, though that relates to the current period, though it relates to the accounting period. It was not realized as a transaction before 31st March. After the closing period, it was realized. Okay. And before the financial statements were prepared. So even if it is realized on 2nd, 3rd, or whatever is the date, if it happens to be before the preparation of financial statement and there is evidence of conditions that existed, they would be included into the financial statements. It would be included, it would be shown as if they have happened before March 2nd. Of course, that is related to the accounting period only. But it was not realized or recognized and recorded in the form of journal entries, ledger posting, etc. So directly it will be taken into the financial statements and the posting would be done. Adjustments would be done. So they are called as adjusting events. What are non-adjusting events? Are those that are indicative of conditions that arose after the reporting period. The financial statements are not normally adjusted to reflect these conditions, but maybe if it is needed, there would be a disclosure note to the financial statements in the financial statement notes to financial statements, additional information. So it would be included in that. It may be considered if it is to be material, maybe an adjusting event if going concern basis is no longer appropriate. So these are not adjusted, but relating to those things, if it is important, if it is relevant to be included in the notes to financial statement, there would be a mention about that. we call such transactions as non-adjusting events. Let's see some of the examples of adjusting events and non-adjusting events. What could be um, appearing as adjusting and non-adjusting? Few examples which are mentioned here are settlement of a court case relating to an issue which arose before the reporting date. So it did not happen before March 31st or on the before the closing date, but because it is all part of that financial year, it is included as if it is an adjusting event, adjusting event. If there is a customer who's become bankrupt, so the loss will be included. That is, the receivables will be adjusted to that extent. If there is any change in the inventory value, then we see discovery of error. Some error was identified, error or fraud which occurred before the reporting date. That was realized after that. So it would be included into the accounting period. Non-adjusting events which are not reflected in the financial statements, see, though they appear between these two dates also, still they are not adjusted in the financial statements. Few examples are, if there is a merger and acquisition, issue of shares and or debentures, loss of non-current assets or inventories as a result of fire or flood, decline in the value of properties and investments. So there would be a major impact of these transactions that would be on the financial statements. So it would not be adjusted into the previous year, that is the year, the date before the closing. So before that, the into that financial statements, these transactions are not adjusted. They would be accounted for in the next financial period because of these transactions, because there would be a major impact. The financial statements, the profitability position, the financial position, all that will have a major impact. Therefore, they would not be included in the current financial year, but it will be taken into the next period. Okay. But anything, if it is felt that it is relevant or it will have an impact on the stakeholders while they take the decisions. So if it is felt that, then a mention about these transactions would appear in the notes to financial statement. Next one is IFRS 15, revenue from contracts with customers. In the principles of accounting, one concept is realization concept. Any one of you know what is realization concept? Anyone remembers what's realization concept? When is the transaction set to be realized? So it talks about
when a transaction occurs, it's realized. Like if we are purchasing any goods, the moment we receive the goods, we realize the transaction. And if we are selling any particular goods, the moment the goods are received by
that's
the
right. Exchange of goods and services, irrespective of whether there is a cash settlement. That is the date when the transaction is set to be realized. Very good. Okay, so that's the realization concept. So here now, when is the revenue set to be recognized? Revenue recognition. There are 5 steps in the process of revenue recognition. Step number 1 says that identify that there is a contract. Okay, what are the 5 steps in revenue recognition? First, identify that there is identify the contract that is present. In that contract, there would be terms and conditions. There would be a performance obligation which has to be fulfilled as part of the contract. So identify what is the performance obligation, what should be delivered to the customer. So when is the revenue set to be recognized is once identified that there is a contract. In the contract there is some performance obligation will be related to either delivering the goods or delivering the service, providing the services to the customers. So some obligation, performance obligation, identify the performance obligation. It is not necessary that there is only one performance obligation in the contract. There could be multiple obligations in the contract. As against this performance obligation, there is some transaction price. So if it is one performance obligation, the transaction price will be related to that. But if there are multiple performance obligations, this price, the contract price, whatever is there, the transaction price should be allocated between or among all the performance obligations. That is the next step. Allocate the transaction price to the performance obligation. Okay. When the performance obligation is met, it is fulfilled, it is satisfied. Okay. At that point of time, the revenue is set to be recognized. So the fulfillment of the obligation is the indication that revenue is set to be realized. It is not see the day when there is a requirement placed or there is an order placed for goods or services, that is not the day when the revenue is set to be recognized, or it is not recognized when the cash settlement is done, but when there is an exchange of goods and services, that is the day when the transaction is set to be recognized. But when how is it recognized? There are revenue recognition, there are 5 steps. So the 5 steps of revenue recognition would be, there should be a contract. In the contract there should be a performance obligation mentioned, multiple performance obligations if they are there. So the transaction price mentioned in the contract should be allocated between all the or among all the performance obligations. As and when the performance obligation is met or satisfied, the revenue set to be recognized. So it would be partially, you see, one obligation is met, to that extent, whatever is the transaction price, to that extent revenue would be recognized. So as and when they fulfill the obligations, when there are multiple obligations, proportionately the amount of revenue also would be set to be recognized. Okay, so that is revenue from contracts with customers or revenue recognition. When would revenues be set to be recognized? The revenue recognition may be recognized at the point of time when control of goods have been transferred from seller to buyer. If it is recognized over a period of time on a straight line basis when a service is provided, to that extent it would be recognized. The next topic is if there are incomplete records. If there are incomplete records, incomplete records, identification of profit figures using the accounting equation. Accounting equation is assets is equal to liabilities plus equity. So elaborate that equation, fit all that information that is available. Anything which is missing can be identified from the accounting equation, or use the ledger account method and then find out. So the accounting equation is assets is equal to equity, liabilities plus equity. Elaborate that. See, as many assets are there, that many number of columns fit into that on the asset side, and equity very specifically as many number of columns are there. Liabilities also as many number of items of liabilities are there. Whatever is the known information, write it into that particular respective field. So in this process, because the total assets should be equal to equities plus liabilities. So in this process, anything which is not known or missing figure is possible to be identified. So when we elaborate the equation, accounting equation, assets is equal to equity plus liabilities. In this manner, the missing figure can be known. Usually this would be more suitable for small businesses because there would be less number of transactions. So this way, when accounting equation method is followed, there would be no need for them to journalize in the transactions, ledger accounts, etc. That would not be required, but have an accounting equation written, and any transaction that happens, that gets reflected into the respective column. After each transaction, there would be balancing of whether the totals on both sides of the equation, are they matching with each other or not, would be done. Very suitable for small businesses with few transactions. This is followed. But as the number of transactions increase, it is not possible to continue within accounting equation format, but the regular procedure of journalizing and posting into ledger accounts, etc., that would be done. So when a ledger account is prepared, so there would be a T form of ledger account prepared with an opening balance on either side. If it is an asset, it will be on the debit side, liabilities on the credit side. See, incomes on the credit side, expenses on the debit side. So that way there would be an opening balance. We see that there is an opening balance and the other transactions that take place. So we keep posting the other transactions into the ledger accounts. See, it should match with see the things when the closing balance is recorded. Then the account should, when it is closed at that point of time, anything which is missing will be identified from the ledger accounts. That is one way to find out the missing figures. If it is a receivables account, for example, so receivables account will have opening balance of receivables on the debit side. So this would be opening balance. The new credit sales that are made will be added here, credit sales. As against the total use from the customers, any amount that is collected from the cash received from the customers will be credited. And then what's the ending balance of receivable? In this way, when the ledger account is prepared, at that point of time, any of the transactions or any item, specifically anything which is not possible to be known, it gets identified. This is one way. Similarly, payables or cash in hand, cash at bank. So as the known transactions are posted into the ledger accounts, then anything which is not known or missing figure, it becomes possible to be identified. So if the cash account is prepared, so what cash balance did they have, what on account of what transaction did they receive money, that will become the total cash balance available. Out of that, the payments that were made, drawings, payments, etc., all that is credited onto the cash account. Then verify with the closing cash balance available with them. If it doesn't match, if it doesn't tally, that would become the missing figure. That is how it becomes possible to identify particular missing figure. Okay, likewise, for whatever is the account, a ledger account is prepared. All possible transactions which are known are posted into the ledger account. Anything which is missing gets identified in this process of preparing the ledger accounts and posting the transactions into the ledger account. How do we calculate? Markup and margin percentages? The profit margin that is added, we call it as markup or profit margin, that is added to the cost of the goods. When goods are to be sold, cost of the goods plus the profit margin will be the sales value. Okay, so the margin is added on the cost price. Okay. Or we see that it is included into the sales price which is decided. There is an example situation given here. If sales is 5,000 and the cost of sales is 4,000, so sales minus cost of sales is the gross profit. If sales is denoted to be 100%, then we find out what is the percentage of cost of sales and what is the percentage of profit margin, gross profit percentage. Sales 5,000 is 100%, 4,000 is what percentage? That gives us 80%. So profit margin is 20%. If the profit margin is included in the sales value. Sometimes there is a markup added to the cost value. So that is, if cost of goods is 100%, on the cost of goods sold, there is a profit percentage calculated. If cost is 100%, let's say markup is 20%. So sales stand at 120%. So sales value represents 120%. Cost of sales is 100%. Then profit margin is 20%. So that is how it would be calculated. So in the while the financial statements are prepared based on whatever is the information given as to what is the profit margin, or for the purpose of analysis, when we have to understand that, see, that could be the sales price is inclusive of the profit margin, or it can be added as a percentage, as a markup on the cost value. Cost plus markup is the sales value, or the profit margin is already included into this 100%, that is the margin. Simple calculations, simple numerical expressions. Now, adjustments related to inventory adjustments. Inventory, how they are adjusted in the books of accounts. Inventory is part of the cost of goods sold. See, we talk about the trading account. Trading account has the opening balance of inventory. Then additional purchases would be made. The total goods that are available. Then we see sales and the closing stock. The inventory is all part of the cost of goods sold. So this gives us, we see the opening inventory, we see the closing inventory as part of the cost of goods sold. What are the adjustments of inventory? See, inventory is one adjustment. Earlier also we did discuss that. The inventory is not possible to be valued by the time the trial balance is prepared. So it is not possible, because see, continuously inventory is issued to the production department. So on the last date, when they have to value for the remaining number of units, so it takes some time, and then that appears as an adjustment. So instead of journalizing the transaction, posting into ledger account, the treatment would be directly appearing in the financial statements. Okay, so the inventory is recorded on the credit side of the trading P&L account. One effect is it appears on the credit side of trading P&L account. The second effect is the benefit out of inventory is not yet derived. Therefore, to that extent, it will appear on the balance sheet, that is statement of financial position, as an asset. So the inventory journal that is accounted is debit the inventory because this value goes to the balance sheet, statement of financial position, and it is an adjustment to the cost of goods sold. That is, it's a part of profit and loss account, trading profit and loss account. Okay, so that is credited. That's the first journal entry. Second one, let's say if the inventory is lost. So how do we remember? See, when we are talking about this trading account, we see that there is opening balance. Okay. Then we see the additional purchases, the number of units, if we are talking about that. This is purchases. So this is available goods. Out of that, see, out of these units, easy to remember logic is a part of the units are sold, a part of the units are remaining as closing stock. Then we see that another part of inventory is lost by fire. These are lost. The total available units for sale, few are sold. There are few which are remaining in the closing stock. Few are lost on account of whatever accident that has taken place. Okay. Now this is a loss. Now how do we account for this? So if these units are, if whatever is the accident that is insured, if it is foreseen that there is a possibility of such accidents to happen in the factory premises and there is an insurance coverage, in that case it would not be a loss, but to that extent the claim would be received from the insurance company. The debit would be to the extent of receivable from the insurance company, because now there is no loss. See, on account of this, there is no revenue generated, nor is it going to be realized in the future period. But as against these units, there is a coverage which is receivable from the insurance company. It would not be received from the customers to whom these goods would be sold because they are already lost. There is a loss. There is a loss, but this loss is already covered by an insurance coverage. Therefore, it becomes a receivable. It is an asset. It is an asset which will be recorded, but it is recorded under a different name called as receivable from insurance company. Otherwise, it would appear as closing inventory. But now to that extent, it will appear on the asset side of the balance sheet as receivable from insurance company, which is adjusted against the cost of goods sold, which is a credit item. So it is a credit given to the cost of goods sold, credit item to the in trading and P&L account. Let's say if the accident is not insured, then in that case it is a loss. So if it is a loss, to that extent, this whatever lost amount will appear on the debit side of the P&L account as a loss. So first, initially, it would be those units versus the value of those units, which is cost of goods sold. So that is the transaction which has to be accounted. So we see that it is credited to the trading P&L account because it is to be an adjustment from the total available stock. It also appears on the debit side of the P&L account as a loss on account of whatever is the event because of which the inventory is lost. Okay, so both of them go to the P&L account, one to trading P&L account. The debit side, it is a loss because the inventory was lost, and credit is, it is an adjustment in the as part of the cost of goods sold. So debit expenses are losses, credit is cost of sales. That is about the inventory adjustments. First one is any unsold stock, the closing inventory because there was no journal entry passed, ledger account posting was not done. So directly when that is accounted in the financial statement, the first effect is it will be credited in the trading account as part of cost of sales. The second aspect is the benefit out of inventory would be received in the next period. Therefore, it appears as a current asset. So it goes to the statement of financial position. Let's say the inventory is lost on account of any kind of an accident. Now, in that case, on the credit side of the trading account, there would be three categories: part of the units that are sold, part of the units that are unsold, part of the units that are lost. And when they are lost, so that is credited to trading account. When they are lost and there is an insurance coverage, to that extent of insurance coverage, it would appear as a on the asset side, it will appear as an asset as a receivable from the insurance company and cost of sales. But if there is no insurance coverage for these units or for those kind of accidents, no amount will be recovered. It becomes a loss. So it first effect is it is part of the cost of goods sold. That is an adjustment against, it's a loss on account of the accident. So it would be debited to P&L. I hope I made it clear. Is this clear? Please respond.
Yes, ma'am.
Yes, ma'am.
The fourth financial statement is statement of cash flows. IAS 7 talks about statement of cash flows. Let's see how to prepare statement of cash flows. See, the financial statements, the first two financial statements that are prepared, that is statement of financial position balance sheet, statement of profit and loss income statement. See, these two are on accrual basis. Accrual basis is even when the cash settlement is not done also, if the transaction relates to an accounting period, they appear in the income statement prepared for that year, and the amounts appear as assets and liabilities in the balance sheet. So they are not on cash basis. They are on accrual basis. The financial statements, these two financial statements are on accrual basis. So they do not depict the cash position of the organization. So how many transactions were on cash basis, or what is the amount of cash flow on account of any transaction that happened during a period is not possible to be known from these two statements because they are on accrual basis. See, realization concept also we mentioned that see, when there is an exchange of goods and services, the transaction is said to be realized and recognized in the books of accounts. See, it is not subject to whether there was a cash settlement. That was not the criteria. So anything that relates to a current period, because there is a concept called as accounting period, all those transactions that relate to this 12 months period or this accounting period only appear in the income statement. So any transaction which relates to the previous period or the future period are adjusted. Even if there is cash transaction taking place related to those periods also, they are not included in the current period. So we do not understand about the cash position from these financial statements. Therefore, there is another statement that is prepared called as statement of cash flow. Statement of cash flow prepared to understand what is the flow of cash, to know that. To understand the cash flow or cash position of the business, the activities, all the activities that are taken place by the business in the business taken up by the business are categorized into three different categories. Okay, we will see. Did you ever learn about cash flow statement? Anytime did you learn?
Yes, ma'am.
Okay. Okay. Statement of cash flow. So it says that it requires the entity financial statements include that a statement of cash flow. That's the fourth statement, showing the generation of cash and cash equivalents and the application of cash and cash equivalents in the period. So how was the cash used? What are the sources from which cash was generated, or how cash was used during the period? What is the balance of the cash available at the end of the period? All these things would be included in the statement of cash flow. Okay. It is considered necessary because profit figures are easy to manipulate, which makes it difficult to interpret an entity's results with confidence and reality. So, to understand what actually happened on account of cash flows. So, this shows the inflows and outflows of cash and cash equivalents. What are cash equivalents? Which are almost in the form of cash. Cash is cash in hand. Cash equivalents are cash which is there in the bank, cash at bank. Anytime it can be withdrawn. So it is not in the cash box. So cash in hand is something which is available in the cash box of the organization. Cash at bank also is in the form of cash, easy to withdraw and bring it into the firm. So that is cash at bank. Another category is there are few securities which can be sold at any given point of time. We call them as marketable securities. Any time these can be sold in the market, there is a market present wherein there is a possibility to sell them in the market at any point of time, easy to convert it into cash. So marketable securities is also an equivalent cash. So there are three items as cash and cash equivalents: cash in hand, cash at bank, marketable securities. So IAS 7 statement showing inflows and outflows of cash and cash equivalents is easier to understand and more difficult to manipulate. So for that reason, there is a cash flow statement prepared. But to prepare the cash flow statement, the activities are categorized into three different categories. First is operating activities. Second one is investing activities. Third one is financing activities. What's the main operation of the business? The main operation of the business is trading. Trading is buying and selling. Anything which relates to this main activity, main operation, which starts from buying of raw material and ends with selling of finished goods. That's the main operation. But this buying and selling should be related to their main activity. So buying of assets is not part of their main operation. Buying and selling of goods is their main operation. When assets are purchased, it is part of, it is an irregular activity out of which benefit is derived for a longer period of time. Okay, so the intention is not to sell it again, but with an intention to use it in the business. Assets are purchased. Asset purchase of asset and sale is not part of operating activities. So buying and selling of goods. So whatever are the goods which they are dealing with. Let's say if we are talking about a computer vendor. So maybe he manufactures the computers and then sells the computers. For any other business, computer is an asset. For a seller who's dealing with the buying and selling of computers, purchase of components, assembling them into computers, selling them as computers, then computers are goods for him. For that business, goods are computers. But any other business, computer is an asset. So we should understand what are the goods which they are dealing with. So those things will form part of the operating activities. But see, it is not just that on one hand goods are purchased, on the other hand goods are sold. There is a whole lot of activities that is included into that. See, when the raw material is purchased, this raw material has to be converted into finished goods. So there is a conversion process which is involved. Only then finished goods are converted, and these finished goods can be sold. So conversion activity would be about production activity, manufacturing, production of the goods. Anything related with manufacturing, production of the goods, so anything related to factory activities, all will be part of operating activities. So buying of raw material, then any expenses which are incurred in the factory, all will be part of operating activities. See, just because they are converted into finished goods, automatically it will not be possible to be delivered to the customers. Then we see that there are certain activities like promoting these things, and then marketing, sales are important. To run all these affairs, there is an administrative activity that is required. So these activities also will form part of operating activities. Main operation is buying and selling of goods. So starts with purchase of raw material, conversion of raw material to finished goods, administration of the business, marketing, selling and distribution. All these things will be part of operating activity. Finally, the goods are sold. The sale value of the goods also will be part of operating activity. Fine. Apart from this, there are certain other activities also taken up by the business. Out of the funds that are available, if there is an investment made by the business into their own business or other businesses, that will be investing activity. What investment do they make into their business? That is, they purchase assets, investment into assets, these assets out of which the benefit is derived. So investing activities is purchase of assets used in their own business, or sometimes investment is made in other businesses, like maybe they extend loan to other business or purchase debt, debentures and shares of other businesses. Investment funds are used to invest in other businesses also is investing activity. Investing into their own business, like purchase of property, plant, equipment, that is also investment. They're investing to get some benefit out of that. Because of use of these assets, some benefit is derived, is investing activity. Okay, like property, plant, equipment, purchase and sale of assets used in their own business, or assets in the form of investment in another business. All these things are accounted under investing activities. First one is main operation of the business, buying and selling of goods. Anything associated with this activity is part of operating activities. Investing activities, when funds are invested into assets out of which the business can get benefited. So investment into assets used in their own business, or investment into another business out of which what is the benefit that they can receive? They can earn a return from the investment made in other businesses. So that is the benefit. So those are categorized as investing activities. So purchase and sale of property, plant and equipment, purchase and sale of shares and debentures of other businesses, or extending long-term loans to other businesses. So that would be part of investing activities. Third activity is financing activities. See, the business comes into existence when investment is made by the owner, or the owner is extending finance to the business. That is when the business comes into existence. So any finance that is raised from the owner or from outsiders is part of financing activity. See, when the finances are raised, finances can be raised from multiple sources. One is from the owners contributing capital, or shareholders um, uh, purchasing shares, or share capital raised from the shareholders. That's one type of capital. Debts can be raised from outsiders, maybe by issue of debentures, bonds, or loans can be raised from banks, financial institutions. These are all sources of finance. As against these sources of finance, the business has to pay a return on the capital as interest on capital. Then we see on the share capital, dividends are paid, but interest on loan is not part of the financing activity. See, there is some other interest also paid on the operating activity. So sometimes some interest is paid as part of the operating activities. So the interest paid on loan also gets accumulated with interest which is included in the operating activities. It goes there. Dividend comes as part of financing activity, but interest goes into operating activities. We need to remember that point very clearly. Sometimes the loans are, loans have a maturity period, loans are repaid. So when loans are repaid, that is an outflow of cash. In terms of debt received, debts raised is a cash inflow, debt repaid is a cash outflow. But in case of equity, there is no repayment. We only see that cash is received whenever capital is raised or share capital is issued, but capital is never repaid during the lifetime. Of course, if it is a small business like a entrepreneur business, we see that drawings could be there, but in case of companies, we don't see that share capital is redeemed, but dividends are distributed periodically. That will become an outflow. Okay, so these are the three different activities. Then again, when cash flow, cash flow statement will have three different activities, but four different sections. Section wise, when we talk about, this would be the first section. Second section will have cash flows from investing activity. Third section will be cash flows from financing activities. So the sum total of all these three activities will talk about whether there is an increase or decrease in cash and cash equivalents. Do they have surplus cash flow or deficit cash flow, increase or decrease? That is understood when we add up all these three activities. Now, in this fourth section, the sum total of all these three activities is this transaction, increase or decrease in cash equivalents. Then to this, whatever is the beginning balance of the cash on cash equivalents is added to this one. And the resultant figure is the ending cash and cash equivalents. So that is accounted in the last or the fourth section. There are three activities, but four sections. I mean, technically they are not mentioned as sections, but for ease of understanding, we see that one part of the statement of cash flow is with respect to operating activities. One section of the cash flow statement is with which deals with investing activities. Third one deals with financing activities. The summary of that will be accounted in the last part of it, wherein we see whether there is an increase in cash balance or decrease in cash balance on account of these three activities. To that, the beginning cash and cash equivalent is added. The resultant figure is the ending cash and cash equivalent. Sounds simple, but it's definitely not easy. See, over a period of time, as you keep practicing it, it becomes easy, but little caution has to be followed when statement of operating activities is prepared. See, the other two are not very complicated, very few transactions would be there in investing activities and financing activities. But operating activities, it's little complicated because see, there is a whole lot of activity that goes into this particular section. It starts from purchase of raw material, conversion, administration, selling, distribution, and the sale of goods. There's a whole lot of activity related to the business that is all accommodated into operating activities. So we need to be careful when operating activities section is prepared. Then operating activities is prepared in two different ways. So we see that there are two different methods of preparing statement of cash flow. So the difference lies with how the operating activities section is prepared. In both the methods, investing, financing activities are the same. The rest of the cash flow statement, right from here, everything is the same in both the methods. The difference is only with respect to how the cash flow from operating activities are prepared under the direct method and under the indirect method. So the point of difference is only with respect to cash flows from operating activities, not with any other part of the cash flow statement. So there are two methods to prepare. There are two methods to prepare statement of cash flow. Okay, cash flows from operating activities. I don't know. I don't remember where else do you prepare statement of cash flow in detail. Management accounting, I don't think you prepare it there. So maybe you will discuss in detail when you prepare, when you study in FR and FM also you don't prepare statement of cash flow. Okay. See, cash flow from operating activities. This is indirect method. I'll explain you the logic. This is indirect method. And there is a direct method. This is indirect method. I'll talk about this indirect method. Then we see statement of cash flows from operating activities in the direct method. See the difference. The difference in the operating activity in the statement of cash flow between the direct and indirect method is all with respect to operating activities only. The rest of the two activities are the same in both the methods. I will explain both of them. Okay. If we talk about the direct method sounds very simple, direct method, but it's actually not so simple. Just take, see, how the operating activities is buying and selling of raw materials and selling of finished goods, buying of raw materials, selling of finished goods. So as simple as that. So if revenue is generated from sales, and expenses incurred are when material is purchased, when other expenses are paid. Okay, so operating activity, direct method simply says that take the revenue that is, or take the cash flows that are collected, take the cash receipts. From the cash receipts, deduct the cash payments. So cash payments broadly in two categories if we talk about. Cash payments made to the suppliers is one category, and cash payments made for the other operating expenses, all operating expenses. So cash receipts minus cash payments talks about cash flow from operations. Story is very simple. Cash flow from operations. But the point here is we do not know what is the cash portion of the transaction during a particular period, because the financial statements are on accrual basis. See, it is not important to understand whether cash was received or not, whether cash settlement was there or not. That is not the criteria. If it relates to the current period, it is accounted in the income statement. So then we need to very specifically identify what portion of the transaction is cash transaction. So cash receipts from customers, only that portion of the sales as against which cash was received is the criteria. The cash amount may relate to the current period, the previous period, or the future periods, irrespective of the time period. If there was a cash inflow, it appears on here in this section as cash receipts from customers. Any year, it is not relevant. Any year, if the amount is received on account of sale activity, it will be cash receipts from customers. So what do? We take the sales value from the income statement. Then we keep adjusting that credit transactions to arrive at what is the cash balance. So those adjustments have to be taken up to understand cash receipts from customers. Similarly, the cash payment to the suppliers and all other operating expenses like rent, salaries, wages, anything that is paid in the form of cash. It could be because there was something due for the past year that it is paid now. It is paid now is the criteria. Payment was made in the current period is the criteria. It may be related to the past years. It may be related to future years. That is, maybe there is a payment made in advance, that also will come here. If the only criteria is it should be related to the operating activities and there should be cash flow. That's the only criteria which is considered under the operating activities direct method. Okay. Take cash receipts minus cash payments. These cash receipts or cash payments may be related to any accounting period. Only thing is it should be in the form of cash. If there is a cash flow, so then we write it as operating activities, cash generated from operation. Simple looking to look at simple, but when we actually solve that, it is not that simple. Of course, right now we are not solving anything. Last day when we have time, tomorrow's Thursday's class, I will discuss about ratio analysis. The balance of the content I will discuss on Friday. Monday when we meet, because yesterday I didn't take the class, we will have one more day extended into the next week. So Monday I will take the class. At that time, any numerical questions which we can cover from any of the topics, we will consider that day and then solve those questions. Okay, now cash flows from operating activities in the indirect method. Indirect method, how do we do that? Able to understand? Are you able to follow?
Yes, ma'am.
If we are preparing the indirect method cash flows from operating activity, see already we would see that there is a P&L account prepared, that is income statement prepared. We see that there are in trading P&L account or the income statement, there are many things that are accounted on the debit side and on the credit side. Out of that, we see that there are operating transactions on the debit side. We see non-operating transactions also on the debit side, that is loss on sale of assets, anything any regular activity, any kind of a loss which is accounted here. If there is interest paid on the owner's capital, if that is to be done, or dividend payment, which are not part of the buying and selling of the goods, but they happen in the business. So all of them are accounted in the trading P&L account. We see some of the transactions are operating, buying and selling of goods. Some of them non-operating in nature, like loss on sale of asset or dividend paid, any kind of an profits that is set aside. So those things are non-operating in nature. We also see that these transactions are in the form of cash and non-cash also. So out of these things, out of the operating, we see some of them are cash, some of them are non-cash. Similarly, on the credit side, we see that they are operating, they are non-operating. Non-operating in the sense, dividend received from investment made in other business, gains realized by sale on sale of assets, non-operating in nature. So these are what we have in, and the resultant figure is net profit or if any net loss. This is what we see in the trading P&L account. Now we start with the operating activities. The starting point is net profit. We start with this net profit. Profit during the year, net profit before tax, we start with this. From the revenue, the expenses are deducted, resultant figure is profit. Out of that, there are certain things which are not supposed to be included under operating activities. Non-operating should not be included. This should be cancelled off. Non-operating incomes also should be cancelled off. Non-cash transactions also should be cancelled off. That's the criteria. Anything which is non-operating in nature, it could be income or it could be expense. If it is non-operating, adjust it. If it is non-cash, also adjust it. How do we adjust it? So we are starting with this one. This is the starting point. Because these were deducted earlier, deducted from the revenue, now what do? We add it back to net profit. We don't want them to ascertain cash flow from operating activities. Whatever earlier which was deducted, because they are based on the rules of accounting, principles of accounting, that they are accounted in the trading P&L account. That's all fine. But now, because of cash flow statement to ascertain the cash flows, we do not want these non-operating, non-cash items to be included. They were already deducted, therefore add them back. Any non-operating, non-cash transaction should be added back. Then, non-operating gains should be deducted. They were added to the revenue, then only this net profit was realized. So since they were added, now it should be deducted. Okay. So any gain which is accounted should be deducted. Any loss is added back. Non-operating, non-cash are added back. Non-operating gains are deducted. I hope I made it clear. Easy to remember logic. Is that clear till here? This part of it? Do you want me to repeat once again?
Yes, ma'am.
Yes, ma'am.
See, when trading P&L account is prepared, based on the rules and rules of accounting, the items would be appearing in the trading P&L account on the debit side and credit side. So they are allowed to be shown. It is an accrual basis method that is followed when trading P&L account is prepared. So all the expenses are accounted here. Some of them are operating in nature, operating expenses, like operation is buying and selling. So raw material is purchased, then wages, salaries, rent, printing, stationery, etc. All that which is related selling expenses, part of the operating activity is accounted here on the debit side, operating expenses. Some non-operating expenses also will be accounted, like non-operating in the sense that is an expense, but it is not related to buying and selling of goods. Like if there is an asset that is sold and loss is realized on sale of asset, buying and selling of assets is not operating activity. It is part of investing activity. But there is a loss that is realized. It it is it is to be charged to profit and loss account because it is part of the business activity, but very specifically operating activity. It is the nature of it is non-operating in nature, but it is included in P&L account. One example is loss on sale of asset. Another example is dividend distributed to the owners. That should go to financing activity. So likewise, we see some non-operating activities also accounted on the debit side of P&L.
Dividend distributed among shareholders, it's a financing activity, right?
It's a
So
financing
it won't.
activity.
So how is it that it's coming under non-operating activity?
Operating is only buying and sell. See, that is financing activity, very specifically with financing, because we have already categorized them into 3 categories. So it should appear. It is not that it is not related to the business, but it doesn't fit into that section because we have divided them into 3 different sections. So the dividend distributed also will be appearing in as part of the statement of cash flow, but under the respective heading. It will not come under this heading.
So, ma'am, if dividend distributed has to be recorded in cash flow, isn't it going to come under operating activities
No,
as well
it
as
will come under financing activity. See, as part of raising the finances, that the dividend is paid. So dividend payment is as against the share capital which is raised. Share capital that is raised is part of financing activity. As against the share capital dividend distributed also should go under financing activity. It will not come under operating activity.
So, ma'am, something can be a non-operating activity, but it can come under other operating, investing, or financing activities.
See, it is part of the business only, but the section wise, category wise, it is not under operating activities. It is not that it doesn't relate to the business. It relates to the business. See, loss and sale of asset is also part of the business activity only. But where will it appear? Where should it appear? It should be part of the investing activity. So lesser amount of cash flow received, that adjustment is done and lesser cash amount is recorded under investing activity. Specifically, the nature of the item is non-operating in nature.
Okay, ma'am.
Okay, so it's not that it is not part of the business. It is very much a part of the business activity only. But heading wise, we write it under the classification. So we are classifying and writing it under the appropriate heading. So dividend payment, loss and sale of asset, these are non-operating in nature. Okay. Then operating, these operating expenses, some of them are cash, some of them are non-cash. Depreciation, amortization, setting aside, anything which is written off. So those things are non-cash in nature. They are operating transactions only, should be accounted as part of the operating activities, but the nature of transaction is it is non-cash. There is no cash flowing out of the business on account of this depreciation, amortization, no cash. There is some asset written down, written off. So that is all non-cash in nature. Then on the credit side, we see there are operating. The main source of operating activities, sales. Sales is the main source of revenue that is generated. Apart from that, certain other sources of benefit also received. Maybe they receive some other incomes from other sources like dividend is received, commission received. They are non-operating in nature. They are not from this business. Some other business revenue is received. Okay. Then any gain that is realized also was included. That is included as part of non-operating. Finally, we see that net profit is calculated. if we are preparing the section of cash flows from operating activities, the starting point here is net profit. We start with the net profit of the current period. The source of revenue is sales. So to this is added. Anything that is deducted on the debit side, anything which is debited in this to this account, is the treatment is they were deducted, out of which we don't want this transaction non-operating incomes, we don't want non-operating expenses, we don't want non-cash expenses to be part of the section called as cash flow from operating activities. They should not be part of this particular section. So what are we doing? This is our starting point. Since these two things were deducted from, see, sales minus sales plus the non-operating, gains, okay, minus operating minus non-operating expenses. When these things are done, is what we have as net profit. We don't want non-operating expenses. We don't want non-operating expenses. So what should be done? This was already deducted. So remove that, is added back. Bring it to this side. So net profit plus the non-operating expenses. This anyway is wanted. Non-operating gains are not wanted. So that will be taken to the other side. It becomes minus. Anything which was earlier added should be deducted. Anything which was earlier deducted from revenue, anything which was earlier deducted should be added back. That's the logic we remember when we prepare cash flow from operating activities. That's only one section of operating activities. Is this clear till here? That's why adjustments for non-cash transactions, CAB, we see adjustments for non-cash, that is depreciation, amortization, that adjustment would be made. After that, non-operating transactions. Loss has to be added back. Loss on disposal of property, plant and equipment is added back. This should be deducted. So it is there in bracket. Gain on sale of assets, property, plant, equipment is deducted. Till this particular part, if it is clear, then we can discuss about the rest of it. Is this clear till here?
Yes, ma'am.
Okay. Okay. So is it only that we take it from the income statement which appears in the operating activities section? See, as part of the buying and selling activities, there are certain items which are carried forward to the balance sheet, to the statement of financial position. We see that when material is purchased and it is not used in the current period, it would be appearing as inventory in the balance sheet, closing inventory, what we call it as. Goods are sold, but cash is not received from the goods that are sold, appears as accounts receivable. Expenses are paid in advance, appears as prepaid expenses in the balance sheet. Expenses are not paid in the current period, appears in the on the liability side as outstanding expenses. We see material is purchased but cash is not settled, appears as part of the liability side of the balance sheet. We see accounts payable. So we see that as part of the operating activities, some of the items are taken to the balance sheet from the items that appear in the balance sheet also, it becomes possible to understand, because these are all part of the operating activities, that is inventory. We see inventory in receivables, prepaid expenses, outstanding expenses, payables. These are all a part of the operating activities. These are dues or over paid in advance, or on account of all these things, we see that either the benefit is yet to be received, or liability to be settled in the future period. On account of that, they are appearing in the balance sheet. From that, it becomes possible to understand what is the cash portion of those items. How do we know that? See, there is a comparison made between the beginning balance sheet and the ending balance sheet balances. Opening balance and closing balance should be considered, and we see that by comparing the beginning and the closing, we would be able to understand whether there was, see, these are all part of operating activities, that much we understood. So out of these things, what portion of it is a cash flow which was realized should be understood. How do we understand that? So we see that there is a beginning balance, there's an ending balance. From where do we take the balance sheets? Beginning balance sheet, ending balance sheet, two balance sheets. If it happens to be a current asset, if it is a current asset is inventory, receivables, prepaid expenses. Of course, cash balance is also current asset, but cash, because beginning cash balance and ending cash balances are treated in the last section, so we do not count for that here in this. The cash balances are separately dealt in another, the last part of it. Though it being a part of the current assets, we do not consider cash balances here. If the current asset, on comparison between the beginning balance and the ending balance, if we see that it is increasing, that is one situation. If the current asset is decreasing, on comparison between the beginning and the ending balance, if it is decreasing, from this we get to understand whether it has resulted in a cash outflow or cash inflow. When the asset increases, when the current asset increases, it results in a cash outflow. Example, inventory at the beginning was 50,000. Inventory at the end is 60,000. Why would it increase? Because additional inventory was purchased. At the beginning it was 50,000, ending it was 60,000. The difference, or that increase in 10,000 for inventory, is as a result of purchase of additional inventory. Additional investment into goods which are sold on credit basis is increase in receivables. Additional amount of prepaid expenses, these things result in cash outflow. If the current asset increases, if it is an increase, it's an outflow, it is deducted. If you can see here, so when we are specifically treating the current assets and current liabilities, we see that the current asset, any type of current asset, when it increases, there would be result of cash outflow. It's a payment, it's an outflow, it is deducted. But if the current asset is decreasing, maybe the customers have paid, that the balance has decreased, so the benefit is already realized, or the inventory is sold, therefore cash balance is realized. So when the current asset decreases, it is added, whatever is the current asset. On the contrary, current liability, when it increases, when there is an increase in the current liability, it is added, it is an inflow. Why would the current liability increase? Maybe short-term loans are raised or something like that. So additional benefit is realized. So that will result in an increase in current liability payables. We see that it is added. But if the current liability is decreasing, maybe they have paid off the current liability. For that, there is a cash outflow. Current liability decreasing is a cash outflow, so it should be decreased. Because these current assets and current liabilities, they arise because of part of the operating activity. So those things which appear in the balance sheet also should be considered to understand whether there was any cash flow on account of operating activities. So that is settled in this manner to understand what is cash generated from operations. From this, any interest paid, any income tax paid is deducted to know what is net cash from operating activities. This is the indirect method, because we do not know the direct method, take the cash receipts from that, deduct the cash payments to know what is cash flow from operating activities is not that simple, because by then already cash flow statements with respect to statement of financial position and statement of profit and loss are already prepared. Because the base is these two statements, it the net profit is the starting point which is taken, and keep adjusting all that which is not wanted, keep making the adjustments, and anything that appears in the statement of financial position which is of the nature of operating activity also should be considered to know whether there are any cash flows, adjust that, arrive at what is net cash from operating activities. Theoretically it is this explanation, but only when you put it into practice that you would understand. Okay. I would want to solve one question at least on cash flows statement. Maybe on Monday I will do, but before that, because the content is also vast, I also have to explain. Now I'll talk about investing financing. I also have to explain about ratio analysis, how the financial statements are interpreted. Maybe tomorrow's class exclusively will go for ratio analysis. Consolidated financial statements and other topics I will talk about in Friday's class. Okay. Monday, I will solve one question on cash flow statement. Anything else which we can do, we'll do it on Monday. So that's the explanation of cash flows from operating activities, both direct method and indirect method. Second section is investing activity. So when assets increase, it is a purchase. It's as a result of purchases. So assets which are used in the business, like property, plant, equipment. Assets could be because of investment in another business. That is anything which is purchased as investment in another business. So those things, when these assets increase, it's an outflow. These assets decrease if because of sale of those assets, that there is an inflow. So just settle those things. Cash paid to purchase property, plant and equipment is an outflow. Any intangible assets purchased is an outflow. Any investments of other businesses is an outflow. But when these are sold, sale of property, plant, equipment, sale of intangible assets, sale of investments is an inflow. Because investments were made in another business, maybe debt investment was made, then interest is received. Shares were purchased, so therefore dividend received. These two things always put us in a confusion. The minute dividend is seen, please don't take it to the financing section, financing activities section. These things arose because of an investment made in another business. So they become part of investing activities. The third section is financing activity. Financing activity is about raising of finances and settling of finances. So when shares are issued, ordinary shares, preference shares, long-term borrowings, these are all inflows. Finances are raised from debt capital, equity capital. Finances are raised. Out of this, debt is repayable. So whenever debt is paid back, that is an outflow. Against these shares, any dividend is paid is an outflow. This is all what we have here under financing activity. So then take all the three activities, sum total of all the three activities. We'll talk about whether there is any increase or decrease in cash and cash equivalents. Add the opening balance to arrive at the ending balance. This is cash flow statement, both methods, direct method and indirect method. I hope the logics are clear. If the logic is clear, any type of question, it becomes possible to answer.
It's clear, ma'am.
So I will end the session here. Tomorrow's class, we will look at how the financial statements are interpreted. Interpretation is one part of the accounting activity. Accounting is the art of recording, classifying, summarizing those monetary transactions for the purpose of analyzing and interpreting the financial statement. So interpretation, analysis and interpretation is also part of the accounting system. So how do we analyze these financial statements? One tool, one popular tool that is used is ratio analysis. I will only talk about that. I will not solve even one numerical question also, because I think management accounting, you must have done management accounting by now, no? This is F3 means F2 you have done. You finished F2, no? But did you finish F2? Management accounting? No, yes. So ratio analysis is in detail discussed under management
So
accounting.
far, we only had F1, financial accounting 1. We're having financial accounting 2 this semester.
Okay. So I will explain all the ratios, but numerical questions I will not touch even one small thing also, because as part of management accounting, you will be doing problems there. Explanation wise, I will talk about it in tomorrow's class. Okay. Then and Friday's class will talk about what does it mean by consolidation of financial statement. Monday's class, some numerical questions will do. Okay. So let's end the session here. I hope things are clear. Then, yeah, good night.